Yo, 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 yo. Welcome back, guys, to a brand new episode of Thompson's Two Cents. I'm your host, Larry Thompson. And today we're going to be ripping through a bunch of charts, going over a bunch of different things, and excited to have you guys here. Today is one of my favorite episodes. All gas, no brakes. I'm already struggling with this setup at the house. Bear with me for a second. There we go. All gas, no brakes. 20 charts in 20 minutes. So glad you guys came back. Sorry it's been a couple weeks. Moved into the new house. Currently, this room is still a mess. Don't even have books on the bookshelf. I need to paint. I need to get a haircut. Who knows? But I also know we need to rip through some charts. So we're going to do what we've been doing. 20 charts, 20 minutes. Gene, go ahead and get the countdown started, and let's rip through some charts. So starting here, S&P 500. Always zoom out, take a look at the S&P 500. And what we're doing here is looking at a weekly chart, seeing this fast recovery, slow recovery, faster recovery. And the thing I want to point out here is it was a rough day in the market, right? Worst day since a lot of that April tariff tantrum in a lot of stocks throughout the market. And so what we want to do is we want to kind of take a step back over the weekend, look at the weekly chart, zoom out. One, define your risk levels, but two, just understand if this has potential to go further to the downside and what other charts we might use to affirm that. So that's going to be the focus today. Not a ton of setups, not a ton of actionable trades right now, because I think you need to take a step back for a minute. Thing I want to highlight here, look at the S&P members above their 200-day. We're not above 70, right? And you see in steady uptrends, we tend to get above 70. That doesn't matter until tech starts to roll over, which we started to see a little bit today. And then you kind of get a day like we had today. So next chart I wanted to go over is the S&P 500. And one of the features of a bull market is quiet strength, right? It's the silent guy in the corner who's just grinding it out, not making a big scene, just slowly but steadily making new highs. And that's what we've had in this market really since the April lows, with the exception of a little bit of a tizzy back in August. But other than that, this bottom panel is showing you the one-day rate of change. And what we see here is that we had one day in August before today. So the market tends to have this quiet strength. When it starts to get loud is when we start to see the trend bend. And so the question is today the exception? And currently it is. So will we see follow through? And this is a chart I'll be watching. I'll be watching the one-day change. And you can see we had a rebound back in August that kind of let us know, okay, it was just an exception to the rule. But will we see that continue? So this is a chart we'll be watching, that one-day rate of change on the S&P 500, because today is bad, but can we see that downside follow through? Because currently it's still counter trend. Next chart I want to talk about discretionary versus staples equal weight, right? Risk on, risk off type of gauge. And once again, the one-day rate of change. And the reason I bring this chart up, I bring up a couple risk metric charts we're going to look at. And the reason I bring this up is because when you have a process, you look at charts regardless of the market environment to try to understand what's occurring. And sometimes you don't like the information you see, but you share it anyways. That's what part of being an investment analyst, that's part of being a research-driven person, that's part of being objective in your analysis. So look at discretionary versus staples on an equal weight basis. We can see that this one-day rate of change actually earlier this week kind of blew out a little bit. The worst one-day rate of change in this ratio since the April lows. And we've actually seen some follow-through in this ratio. So this ratio was giving us a little bit of a warning sign, a little bit of a heads up, and then we saw follow-through through the 50-day, which we didn't see back in August. So people comparing this exactly to August, no, it's actually a little bit worse than August. Let's look at another risk ratio. Let's look at high yield corporate bonds versus treasuries, right? So junk bonds versus treasury bonds, right? Risk on in the top panel versus risk off in the bottom panel, and then the ratio in the middle. So you can see here, this chart wasn't confirming the new highs we made in the market. But, right, there wasn't a weight of the evidence that said, oh, you need to get out of the market. There's not a ton of stuff that it's just saying maybe not add here. Pay attention here. And so seeing this ratio kind of start to cracked back down, right? Making new lows since May, right? This is the lowest it's been since back in May. So 6-month lows, essentially. What we see is that the people are going a little bit more towards safety, and they're kind of erring away from the junk in the bond market. So stock market, right? Let's look at high beta versus low volatility, another risk on, risk off. And until today, this ratio wasn't correcting. And so when you're doing some analysis, what you would say is that the beta was the exception to the rule. When we saw other risk on, risk off ratios starting to correct, beta was the exception. What is the largest component of S&P 500 high beta? Technology. So technology was the exception in the market of things that were still going up, still making new highs. And when technology makes up 33% of the market, it can mask a lot of the weakness that we'll get into under the surface. This is why we do this analysis. It's why we're going to go through some breadth charts that showed, hey, there's some things underneath the surface to think about, and maybe not be adding exposure here when it's solely tech to a degree from an S&P 500 perspective that was driving the market. So that's why this ratio didn't really start correcting until today, and then it's down 5% today. Okay, so look at something like consumer discretionary. Let's kind of look at these sectors now. If you look at something like consumer discretionary, what you see here is that we were in this bullish regime. We had a breakout, but this breakout failed. This breakout stalled, and then today we had follow through to the downside. So failed breakouts can tend to lead to fast moves to the other side. And if you were in this, that was your risk level, right? And so there's no reason really to be in consumer discretionary if we're below this former high, right, that we made back in December. And so maybe we have about another 5% we could fall here in this ratio to this 200-day moving average and this all-time high AVWAP. So maybe there we would look to buy. But we don't buy until we see some strength after the dip. I'm not a buy the dip guy. I'm a buy some strength with well-defined risk after the dip. So it's going to take a few days for that to occur, which is why I'm not coming here today pounding the table on any individual stock you need to buy, because that's not my process. That's not how I go about the market. Sure, we might get a rally on Monday, but I don't think that necessarily is how I trade the market. That's a lottery ticket. The next chart I want to look at. So energy, did we see a spike in energy today? Was this driven by some geopolitical risk, some inflationary risk? No, energy actually corrected as well as the rest of the market today. So that to me leads me to believe it's something related to growth. It's something we're seeing bonds, and we'll get into some bond charts. It's something related to growth. It's something related to Fed having to maybe cut rates because of growth, and maybe the Fed being a little bit behind the curve. It's not something related to inflation that everyone is still kind of worried about. Something related to which is why you see growth get hit so hard. It's why you see tech get hit so hard. So something like energy still failing to break out. So to me, no real reason still to be overly concerned about inflation from the market from this perspective, right? Gold and Bitcoin, I don't think it's an inflation story. I think that's more of a debasement of the dollar story and a different type of asset story. I don't think it's inflationary driven. Also want to look at energy just from a different perspective. You zoom out and you look at energy here. It's gone sideways for a long period of time. And that to me is a good thing, right? I went and got gas the other day, went to Costco, shout out Costco, shop at Costco, because they keep the cost low. I digress. So energy trading sideways here, had a nice run off the lows, but so did everything else, because stocks tend to participate in bull markets, but we're not breaking out here. So energy kind of rolling over where it should to a degree, where it could to a degree, is interesting, because what's that tell me about the market overall? That inflation isn't necessarily the worry, which I think is bullish from the perspective of bonds and that relationship with stocks, because inflation is what hurts that correlation. So why do I mention that? Because if you look at energy and yields, this is a 10-year, they tend to be very strongly correlated, right? Think about it. Energy is the first input into anything in society. It's you got to put gas in your gas tank before you go anywhere or do anything. And any production facility involves energy being the first derivative. Okay, if energy prices rise, right, that's an inflationary pressure. That kind of leads to the Fed raising rates. So when you see energy correlate, that tends to be how it works. So if energy is correcting a little bit, yields can then have more room to come down, which means bonds could then go up. So you see the 60-40 portfolio being dead might not actually be the case. Adding some bond exposure might be a way to diversify against the market, which is a good thing. Next chart I wanted to talk about. This was an area I was looking at. It's an area I had some exposure to, right? I got hit today. Right? It was hard not to get hit today, but I was looking at adding some healthcare exposure due to some of the rotation we just talked about prior to today. And we had a nice little bull flag forming in names like Johnson & Johnson, Eli Lilly, Gilead. They were starting to shape up, and then everything kind of got whacked today. So there's no real place to hide in the market. But healthcare was something I liked, and I might still like if we kind of get back down here and turn this 140 level into support and we kind of go to the upside. Healthcare kind of has a defensive component to it, especially with when it comes to health insurance. And so this is an area of the market that if we do continue to correct, I might look for some outperformance in healthcare just from a defensive asset perspective, because it has just a little bit more defensive play to it. Technology, right? That's the big story. This is the big kahuna. This is the Achilles heel of the market. It's also the MVP of the market. It's everything to the S&P 500. It's 33%. It's actually 34% of the S&P 500. So over a third of the S&P 500 made new all-time highs 2 days ago. And then we have this huge 4% down day, worst day since, right? The tariff tantrum that we had back in March, April to kind of start the year. And so the question is this going to continue to see follow through? We have some clean levels to manage risk against. So I don't think you panic here, right? Maybe you get out closer to some levels, key levels down here that you might think we break down against. But this is why now everything else matters, because nothing matters if tech is on the field. As soon as tech gets stripped away, everything matters, right? Great quote by Baker Mayfield. He said, the narrative depends on whether or not I'm winning, right? The narrative of the market depends whether or not tech is on the field. If tech is not on the field, every bearish story now has plausible ability to unfold because the market leader is gone. Another area of the market that I like to look at, if we're talking about tech, is talking about economic sensitivity, talking about those types of things, is industrials. I want to see industrials not only participate, but I want to see outperformance from industrials from economic, kind of knowing what area of the cycle we're in. And you can kind of see here, industrials on a relative basis have been lagging, but that's because of the tech outperformance. But on an absolute basis, we're kind of trading sideways. And I thought, okay, more of my concerns will grow. We looked at a couple risk ratios. Okay, so checking the box of, okay, my bearish list is kind of growing a little bit. And I was like, okay, if industrials fail to break out here, that'll really have my attention. What do we see? Saw another failed breakout in industrials. So now downside has my attention. Adding exposure is not my goal right now. Protecting my income, right? Being in asset protective mode in the intermediate term is the goal right now. And the reason industrials matter to me is because of what's been occurring underneath the surface in home construction and home builders. So XHB is home builders, ITB is home construction, basically trade very similarly. In this example, I'm just using ITB. You have the potential for a large top forming. We nailed this bottom, right? Because we had clean risk reward, right? This is when you can buy a dip, is when you have clean risk reward. We don't have that right now. So if we are going to add exposure here, we might wait for more downside follow through to see this top fail before we add exposure. But right now, this is concerning. This is a concerning look for home construction. We know the importance of homes and housing to the economy overall, right? You don't have to look far to understand that. Here we have the S&P 500 home builders, home construction, semiconductors. I think these three areas of the market, and then you have the fourth being the S&P 500, really can kind of give you some insight into Dow theory type analysis, where do we have confirmation or do we have divergences, right? And what we're seeing here is to start the year, we had home builders and home construction lead lower, and then the S&P 500 and semis, tech to a degree, followed them. And then off the lows, we had the S&P 500 and tech lead, and then home construction, home builders follow. Well, now home construction and home builders are breaking back down. Will the S&P 500 and semiconductors kind of follow? With what we've seen, I would not be surprised if that's the case. And this to me is the bearish thesis. Housing issues is the bearish thesis. So that's how I see this. That's because of growth. That's because of most likely rates being too high and the Fed being a little bit late, and that will lead to a growth scare, which could be a risk to the market. We talked about it already, right? We talked about why breadth now matters is because the MVPs, right? Patrick Mahomes gets injured. Everyone else needs to step up. Joe Burrow gets injured. What's happened to the Bengals? They look like absolute dog shite. Bengals look like crap. Why? Because their quarterback is injured. This is the quarterback of the market, right? And it's injured. It got injured today. We had a basing pattern here, consolidation, and we saw follow through to the downside. Right? We have a decent amount of room we could fall. So until this leadership gets back on the field, the market's not healthy. There's no reason to be placing a bet from a market cap weighted perspective that we're going to go higher. And so I know I sound really bearish right now, but this is just the context of the intermediate term to shorter term of the market. I'm not trying to add exposure until we start to see some processes change. And reality is this has been occurring over the past 1 or 2 weeks, and I've been absent due to the move. Another chart I like to look at, if let's look at breadth, right, is this equal weight Russell 1000, which we've talked about in the past from a bullish perspective. We made all-time highs just last week or 2 weeks ago. And what do we have? We had a failed breakout. Fast downside move today. Worst day since tariff tantrum. You're going to see that a lot. Worst day since, worst day since. The question becomes, will we see that downside follow through? And so that's where that rate of change chart comes into play, because we want to see if we see that downside follow through, that's when you want to start to worry. That's when you maybe want to start to disallocating from the market even more so, right? And that's what we're looking at here is this equal weight Russell 1000. Failed breakout here is pretty significant because this represents 93% of the total equity market in the US. Same thing here, S&P 100 equal weight, the big guys, the big dogs, right? We know it's a market cap weighted world. Worst day since tariff tantrum, okay? But here we have a little bit more well-defined level we're approaching. So next week, this is what we're going to be watching, right? That's why I wanted to do all gas, no breaks today. I wanted to show you guys a bunch of charts to be watching this upcoming week, and I'll be sharing them throughout the week. But will we kind of see this level here that was former resistance, became support? We kind of had a base breakout. Will this turn into support? Because that would be, okay, now we can start allocating again. Even though I sound panicky right now, it's not that I'm panicky. I don't know the future. Right? With a day like today, right, you're not rushing in to get exposure until you see, right, the market got punched and it's on the ground. I want to see it get up first, right, before I start placing bets that it's going to win the fight. And then the last couple charts I wanted to show today, really I wanted to show you guys some things underneath the surface that were popping up and why there's basically two levers in the market. You have breadth and you have tech, right? You have the market cap weighted concentration. So concentration risk exists and breadth doesn't matter until concentration risk starts to unfold, which is what we're seeing. So we see here, like, look at the S&P 500 above their 50-day. We've seen lower highs. We've seen lower highs. We've seen lower highs. Didn't matter because tech was on the field. But now with tech off the field, this breadth all of a sudden matters. I would also say here, probably not the time to be trying to short the market because of the fact that it's pretty overdone to the downside from a breadth perspective, Okay, so tech would probably be the place where you want to look that probably has plenty of meat on the bone. I don't know if there's a ton of meat on the bone left, intermediate to short term, for downside from a breadth perspective, because we've kind of seen a lot of it unfold. So look at the 20-day, right? A little bit shorter term perspective. We're at 17%, 15%, and 28% in terms of the S&P 500, 400, 600. This makes up the S&P 1500, right? We're at levels where kind of see washout. These are like washout levels in this analysis. And it matters now because we've seen that tech pullback. So for me, it's not a place I'm currently trying to short the market overall, right? Probably shorting things that are close to highs and you have clear risk against. But to me, it's just a wait and see. And that's lame, but that's part of the process, right? Most people are trying to sell you something to get you to act. One, because they know your actions are probably going to be poor. And if your actions are poor, you're going to keep coming back to them to try to help them solve it. Reality is just take a step back and let this unfold. We've had one day of bad price action, and we want to see follow through to the downside before we start to, and we want to see either follow through to the downside to maybe reduce exposure, or we want to see kind of something stick, right? See capitulation before we start thinking about adding exposure. And that might take a couple days. The last chart I wanted to share here is probably, I guess I don't know what you would call it, the silver lining. The silver lining is that this isn't about inflation and that bonds are doing okay, right? Bonds outperform today. And the beauty of that is that means you have somewhere else you can allocate. And so if I like the looks of bonds here, we've talked about this chart before. We actually talked about it with home builders. We talked about adding home builders, adding bonds. I wrote an article a while ago. I can pin it in the chat, but you can look it up on hostile charts. It's like bottom fishing. This was something we were bottom fishing. So seeing bonds hold up here is great because it's probably a growth scare, which isn't great for stocks. But if you have somewhere else you can allocate, that's bullish because we're agnostic to what we're allocating to. So I like bonds here. I've liked bonds here. You have clean, well-defined risk against 89 or 87. This 200-day, I think, right, we're seeing some follow through. We're seeing RSI 50 turn into support. So something like bonds is an area I like to continue to add some allocation to, because if growth is going to continue to slow, we're going to continue to see that the Fed is probably going to be forced, if they're data dependent, which I believe they have been, to continue to lower rates. And so this is an area that the S&P 500 doesn't give you exposure to bonds. So, and for retail investors, they're not thinking about 60-40 allocation. They're not thinking about that diversification of bonds when it's growth related, not inflation related. So bonds is an area I like overall, an area I have some exposure to that I'm happy I had exposure to on days like today. Overall, I think everyone got hit in the market today. It just happens. It's hard to predict these types of things. It's hard to predict Trump's going to send a tweet and there's going to be reaction from that. The last thing I'll say here before I kind of talk through how I go about my week is technical analysis gets a lot of flack for good reason. I'm a CMT. I'm also a CPA. I think one of the reasons it gets a lot of flack is days like today. You're going to see a lot of people on the internet saying, this was a warning sign. Price told me in advance. Yes, there was individual things that were bearish, but the overwhelming weight of the evidence and the overall arching trend of the market was up. And so don't allow them to confuse you that technical analysis is this perfect thing that avoids every type of drawdown that exists, because it doesn't. It's just a risk management tool that allows you to stay on the right side of the market the majority of the time. And if you do that, you can do pretty well. It's hard to predict these types of things. So just keep your cool, keep your patience. Let's look for follow through next week. And I'll be writing about that. So I really do appreciate you guys watching. Coming back to another episode. Energy might be a little low today. First day back, maybe a little couple tongue twisters, but I do appreciate the love. I'll write a blog tomorrow kind of highlighting more of this. Because like I said, I'm not putting on trades, so I'm not going to fake it and send out 25 different trades that you could put on a Monday. That's just not how I roll. The Sunday stock list, probably be a lot of these charts, because these are the charts I'm going to be watching this upcoming week. And Tuesday, Thursday, I'll put out my notes. And then Friday is Thompson 2 Cents Live. So I appreciate you guys, appreciate the love. If you could give this video a like or a comment, or both, comment a chart you want me to look at, comment some things that you might be seeing that are bearish or bullish, and how you evaluate on a day like today when it's the worst day since the tariff tantrum and it's a Friday. Kind of what are you going to be looking at this weekend? Let me guys know what you're looking at. Also, let me know about some paint colors for this room because it's pretty ugly right now. It's a huge room. We're going to do a lot of work in it. But yeah, let me know paint colors. Let me know some of the charts you're looking at. Have a great weekend. Much love. Peace, guys.